The real estate market, is it all doom and gloom? Is it crashing? A lot of people and their mothers seem to be weighing in and giving their opinions, but let me tell you a couple facts that haven't really been discussed. So first thing I want to start off with, everyone is saying, oh my God, there's a crash coming, there's a crash coming. Well, what does that really mean? A crash really means, a lot of people are over leveraged, paying completely overpriced homes, and they can no longer afford it, and they basically have to bail out. So one of the first things I want to point out is 37% of homes as of 2017 were completely owned outright and clear. There's really no way for these people to lose money because, everything is in the home already. They don't own any debt. Their home is completely clear. Yes, their home price could decrease in value, absolutely, but they're still sitting on that chunk of money. So, they're gonna be fine. And that was back when it was $235,000 for the median purchase price. As of 2022, quarter one, median purchase price is $428,000. And yes, again, I know if prices go down, they could lose money, but they basically already doubled for free. Even if there's a slight price correction, they're still going to be making out in money. They're going to be fine. And they can always hold on. They're not forced to sell. Obviously people have to buy and sell regardless of the market, but these people can probably get away with, holding off, and we have market ups and downs all the time. So, if they can just survive this this brunt of the market, then they can just wait it out. And 70% or 68% of adults over 70 are the ones that own their homes outright completely. So we are going to experience the great wealth transfer, according to Forbes. So over the next 10 years, if you haven't already coined the term trickle-down economics, this would be a great time for trickle-down economics because a lot of wealth is going to be handed from the older generation to the younger generations. How much? An estimate of $30 to $68 trillion. If you wanted to do the math, it basically equates out to $235,000 per individual in the United States, or if you're a married couple, approximately $500,000. So that is quite a bit of money, and it's definitely a couple variables that I'm not seeing discussed with the market. So let's talk about the big one. Everyone's talking about interest rates, and it's no secret interest rates are rising. As of today, they're just above 7%, and that really limits the monthly affordability versus a low 3%, 2.5% interest rate. So in 2021, about 25% of people refinanced according to the Federal Reserve. Now, if you include the people that own their homes outright, obviously they don't have a loan. So 37% plus 25%, if my extraordinary math skills are correct, is 62%. Now, 62% I'm assuming are probably not struggling with any of their payments. Now, I was recently at a real estate conference, and one of the guest speakers is a realtor. He's also a real estate coach. His name is Jared James. And one of the statistics he pointed out to me that was absolutely enlightening was basically just how much money is currently in the real estate market. Now, in accounting terms, assets equals liabilities plus equity, liabilities being the debt. Currently, there's about 41 estimated trillion dollars in the real estate market. How much do you think is in the debt side? How much do you think is in the equity side? Well, according to Jared James, 29 trillion is in the equity side, and only 12 trillion is in the liability side. This means, Americans have a lot of equity in their homes. This is really nothing like 2008 at all. In 2008, they were handing out loans left and right like candy. You didn't need to show any proof of income, no tax returns. That's really what caused the 2008 crash. This is going to be completely different. Americans have a lot of, equity in their homes. They're probably, and that's not even including the people that did purchase at that time. This is refinanced. If you purchased at that price, that's probably another huge percentage of people. You remember the days, the last, couple of years where you put an offer in on a home, and guess what? There were 50 other offers in just 2 days. That's not including all those people who locked in their home prices and their monthly payments. They're probably not going to be moving for a while. And if you purchased, in the last couple of years with the intent to just move right away, you're probably not making a wise decision. So, You know, a lot of people have equity in their homes, a lot of people are not moving at all, and that's what we're seeing currently in the real estate market. We are the world's reserve currency, so anything we do affects every other market, and more so really drastically affects the emerging markets. With us raising our interest rates, other countries basically have two ways to fight it, and we'll take the examples from the Bank of England and Japan. So, what are the two ways to fight it? Well, they could raise interest rates along with us and then be completely fine, but their economies are basically crushed. Or they could, not raise the interest rates and their currency will just get completely destroyed by ours and lose value, which you can see in the yen. Right now, the yen is completely tanking. They are losing value. If you want to go to Japan and you're American, probably now is a great time because you can get a lot of value out of your dollars through the yen. Bank of England did not take the approach that Japan did. They were apparently, according to Bank of England themselves, just hours away from losing all their pension money and had to jack up their interest rates really quickly and respond very, very quickly. Now, you have two options. Raise your interest rates with the Federal Reserve and crush your own economy, or keep them low, try to fight it off, and face the devaluation of your own currency versus ours, the United States dollar. So, moving on to the other variables, we have supply and demand. Currently, supply still remains low. Demand obviously is decreasing by the day as well, with interest rate rising and monthly affordability dropping. Average days on market is now about 2 months or 60 days. So it's going to take some time for the new comps to justify the new price. So basically everything is at a standstill. We're in hibernation mode with our market. Wealth transfer, own versus paying, we briefly talked about it earlier. 37% of all homes are owned. We had a lot of people refinanced, so we're fine there. Immigration goes hand in hand pretty much with supply and demand as well. Everyone needs a place to home. Everyone needs a home, a place to live. Stock market and 401ks. A lot of baby boomers have their wealth and retirement savings in stock markets and 401ks. So with those dropping, they're panicking a little bit because they're going to need to pay off their mortgage debt somehow. With inflation going high, prices of gas, energy, food, all that stuff is also forcing them to pull out some money as well. Renting, if you're not buying with these prices, you're going to have somewhere to live, so you're going to rent. What's that going to do? Well, if there's a huge demand for rent, rents might go up. So why am I bringing up these examples? Why am I bringing up the Bank of England, Japan, so on and so forth? Again, the United States currency, we are the world's reserve currency. Most goods, most commodities are traded in US dollar, means everyone wants US dollar. Everyone trades in it, everyone needs US dollar. So when our dollar strengthens, obviously that decreases the purchasing power of other countries. So they're forced to basically follow the will of the Federal Reserve. When we increase our interest rates, they either have to do the same or face the devaluation of their own currency. So 2008, if there is a crash, it's going to be nothing like 2008. I want you to picture, the global economy as a bunch of dominoes. And basically the last domino that would fall is the American real estate, market. We are going to be one of the last dominoes to fall if there is a massive, massive crash. Everything is going to be connected globally. So if there's a crash coming, you're going to be able to see it coming a mile away because we will see other countries crash first. Our real estate market will be one of the last things to crash. So to summarize, what do I think is going to happen? Well, we will see a price decrease, but I think it's going to be much slower than people think. There's a lot of people saying that it could decrease up to 50% the prices. I don't think it's going to get that drastic. Again, I think we're in complete hibernation mode with people having refinanced in 2021 and people outright owning their homes. There's a lot of people just completely sitting, nothing's moving, supply isn't moving. So I think prices are going to decrease, but very, very slowly. Also, again, I'd like to reiterate the fact that we are a globalized economy, and if we were to crash, we would be one of the last dominoes to crash, and we would have way bigger issues way before then. So, but that's another talk for another day, another video. And I would like to thank you all for watching. Please be sure to comment, subscribe, and like, and thank you for watching.